Hello, everyone. Welcome. Hopefully, at this point, you've already worked through or tried these problems that we given here to practice gains and losses and comprehensive income. That you went through and wrote the journal entries to record the purchase of this bond, okay, the interest payments, the revaluation or the new value of the bonds and how that needs to be adjusted, and the ultimate sale of those bonds, okay, and that you've shown what the accumulated other comprehensive income was at the end of each of those years as well, okay, if this was the only thing that impacted it. And you've done the requirements here for Home Depot, showed the journal entry, recalculated the net income starting with the 4,000 that was given, 4,000 million, 4 billion, and created a statement of comprehensive income. So here's what should probably look like. Again, there's more than one way we could do this, but this is something that will at least give you some idea of what you did correctly and incorrectly, and maybe improve upon. So first of all, we're going to account for the purchase of bonds by debiting the held for sale debt investment and crediting cash. The number we're going to use is the $150,000 given plus the $100 commission. We include commissions in our cost when we record investments. Okay, so that's added to the cost. Just like any purchase of an asset, the cost of that asset includes other fees and things that are necessary to have it ready to use. Okay. After we've owned it for 3 months, we're going to be owed interest. Okay, we're going to have interest receivable for 5% divided by 12 times 3. You see the formula there. Okay, and interest income. Revenue, if it's something that happens all the time, we tend to say, use the term revenue to describe the things that are, our focus of our business. And other income tends to go at the bottom and be those things that are less important, not a focus of the business. We don't know for sure, so we could use either one. Okay, we're not going to be particular about that. All right, and then the thing that's kind of we're focused on here is what happens when we have this new value. I mean, we bought it at one price, but it has gone up in value, and it's gone up, okay, by $30, right? But so we need to end up with a value of 150 bonds times 1050. No, 1030, sorry, is the first value. So we need to get to 154,500. That's what we should show on the balance sheet, because that's what it's worth at the end of the year. So we need to debit the held for sale debt investment or valuation of 4,400. You see, I have a formula there that recalculates that automatically, and that is what happens. It gets to 154,500, which is what we know it should be. That's an unrealized gain, which is part of other comprehensive income on the statement of comprehensive income, and ultimately ends up changing the accumulated other comprehensive income on the statement of equity. So your AOCI would be 400,000 plus the 4,400, right, at the end of 2022. Now, the other option for this is to use a valuation account. Instead of adding it to this particular, you separate. If you feel like there's going to be lots of fluctuations, that make more sense than do it right here. Okay, you do it in a separate account. But just so you know, if you use that valuation account, okay, it would simply be added, whatever it was at the end of the year would be added to the original cost that was held here and added together and put on the balance sheet. So the balance sheet would look the same, right? Because it would include both. Either putting them together this way, or you would add the total from the you just have it look like this, and then you would add these two together at the end of the year and put it on the balance sheet. Okay, so again, the mechanics can be a little different, and we get to we tell the same story, the same result, and that's what matters. Okay, then we have an interest payment receipt. We receive cash. Okay, and we credit interest receivable that we originally recorded, and interest revenue or income, again, depending on which one we determine it is. And then we're going to have the same accrual at the end of 2023. Exactly the same dates, because it's just going to happen every year. And interest income or revenue. So the thing we're focused on is that new value of the bonds. The bonds went up by another $20 per bond. So 150 bonds, $20. We're going to increase 3,000 and have an unrealized gain, which, as I put in parentheses, is part of other comprehensive income, because this is a held for sale debt security. The one thing where unrealized gains or losses do not go on the income statement. They go on the statement of equity, a statement of comprehensive income. Whoops, need another zero. 3,000 there, and is about, we know that's going to go on the statement of comprehensive income and ultimately end up in AOCI. So what is our AOCI at the end of 2023? It is 407,400. Okay, and our held for sale debt is 157,500, or it's 150,100, and you have valuation for 7,400, whichever you prefer. And then you sell it. We get the cash. Okay, record that. We credit the held for sale debt security for the original cost. This is the original cost. And the difference is a realized gain. And all realized gains, no matter what the asset is we're selling, no matter whether it's an exception for unrealized or anything, it is on the income statement. So I put that in parentheses to remind myself, not that you have to do that, but as a remind ourselves that that goes on the income statement. 7,400. And, okay, we have to get rid of, okay, the AOCI that is attached, if you will, to this investment, because the investment is gone. So any accumulated other comprehensive income that's based on this unrealized gains that have happened in the past has to get reversed or maybe go away. Okay, and so we're going to debit accumulated other comprehensive income, right? That's the debit is going to equal the two credits earlier, and we're going to credit the investment. So what's going to happen here? Okay, you're going to have 7,400, and your AOCI is going to go back to 400,000. So that's where you started, and that's where you end, since the investment is now gone. So you don't have any AOCI associated from that investment. And of course, you have to get rid of the actual security. And again, if you were using a valuation, this 7,400 would be over here, and you would credit valuation 7,400 instead of the held for sale debt. Either way, you're going to end up with 0 in the held for sale debt and 0 in the valuation. Okay, you're back to where you started with the AOCI. That's the moral of the story. Okay, moving on to problem 2. Okay, again, we have a sale of bonds. We have some information from Southwest, or what did I use? Home Depot, sorry. All right, and we're going to record, first of all, these bonds that were held for sale, just like the ones here. So they're an exception, if you will, but once they are sold, they go on the income statement. So we're going to debit cash, 100. We're going to credit the original cost. That's what we do when we sell them, actually sell them outright. And we debit realized loss, which is on the income statement. Again, we didn't have to do that, but I put that in parentheses. So just like when we realized the gain up here, we realized this loss, right, on the income statement. Now, we could make a journal entry for taxes right then, or we can adjust for it later. It's up to you, okay? But the taxes on that would be 20%. You save taxes because of that loss. All right. So most companies would probably wait to adjust that until we use it on the financial statements. All right. We'll learn more about those journal entries to adjust for taxes in a later week. Okay. Then we have to get, just like we did before, when we had to get rid of the 7,400 because that has to do with an investment we had already sold. We have to get rid of the accumulated other comprehensive income from past years having to do with this bond that we're now sold. So we're going to debit, because there was a credit there already of 9. We're going to debit 9, and we're going to credit to the held for sale bonds or the valuation account, whichever way we're choosing to use it. Okay. Then they gave us some information, and we realize by reading it that they missed this loss because the net income doesn't include any losses or gains. Okay, so we start with the 4,000 they gave us. It's after taxes. So when we put the loss on here, okay, 20 subtracted, we also have to adjust for taxes. We have to consider 20% taxes on that $20. So a $20 loss or $20 million loss or whatever is going to save us $4 million in taxes, 20%. Okay? And so our new net income, now that we've realized that we should have put this on the income statement and made the correct update, it is $39.84. So that becomes our starting point for the statement of comprehensive income. Statement of comprehensive income always starts with the net income, and obviously the most up-to-date net income number we have, obviously, is what we want to use. And then we were given two things that were clearly part of other comprehensive income from our list that was given in our notes and our learning activities: pension gain and cash flow hedges. Okay, neither one of those go on the income statement. They go on the statement of comprehensive income as elements of other comprehensive income. And I want you to get in the habit of separating other comprehensive income. Okay, and then the other one is that 9 we just dealt with, right? We have to get rid of it. It impacts AOCI, so it is part of other comprehensive income. Okay, and since it is a debit, it's going down, right? Because these are equity accounts, so debits make them go down, credits make them go up. So together, this gain, loss, and loss, okay, have total other comprehensive income of 21. We calculate taxes at 20% of that, round it off, okay, and we have a tax impact of 4. Subtract that, and we get our tax after taxes of 17. Okay, now the other way to show the taxes is to do it on each item. So on this one, for instance, we would go equals 80 times 0.8. Okay, it'd be 64, right? That's what it is after taking 20% of taxes out. You gained 80, but you have to pay 16 in taxes, so you only end up with 64. If you do it that way, and that's fine, that's more than acceptable, that's perfectly acceptable, then you'd want to put an explanation saying this is after taxes, just to emphasize, okay, like that, something like that. Now, so that's one way. This is the other way. This is separated out. You can clearly see what the impact of taxes is. You don't have to put any in parentheses or anything. And then your net income, okay, plus 17 is your total comprehensive income. Your statement of comprehensive income has net income other comprehensive income, including tax impact, and then get your total. All right. You should be able to think through those, be able to dig in on the homework now.